Welcome to House Lux Estate, your number one source for all things related to real estate and investment. Here at House Lux, our mission is to empower you with the knowledge and tools you need to make informed investment decisions. We believe that a good investment isn't just about making a profit, but also about managing risks effectively. Investing can be a labyrinth of opportunities and challenges. One wrong turn could lead to losses, while the right move could yield significant gains. That's where risk management comes in, serving as your compass in the investment maze. It's all about balancing the potential for returns against the possibility of losses. In this complex world of investing, understanding and managing risks can make the difference between success and failure. That's why today, we're going to explore the best practices for risk management in investing. Stay tuned as we delve into the mysteries of diversification, portfolio review, market trends, and seeking professional advice. First and foremost, it's crucial to understand what risk in investing means. In its simplest form, risk refers to the possibility of losing some or all of your investment. It's the uncertainty that surrounds the potential return on your investment. Now, there are various types of risks that you might encounter. Market risk, also known as systematic risk, is unavoidable. It's tied to overall market movements and can affect most, if not all, securities. Then there's specific risk, which is unique to a particular company or industry. For example, a sudden change in a company's leadership or a disruptive innovation in an industry could impact your investment. Credit risk involves the possibility that the party you're investing in may not be able to repay their debt, affecting the value of your bond investments. Inflation risk, on the other hand, is the risk that the rate of inflation will outpace and erode investment returns over time. And let's not forget about interest rate risk. This is the risk that an investment's value will change due to a change in interest rates. For instance, when interest rates rise, bond prices tend to fall. Now, what happens if you don't manage these risks effectively? Well, you might end up losing a significant portion of your investment, or even all of it. And this isn't some hypothetical scenario. It's a stark reality that countless investors have faced. But here's the thing. Risk isn't necessarily a bad thing. In fact, taking on more risk often leads to higher potential returns. It's all about finding the right balance and knowing how much risk you're comfortable with. This is where risk tolerance comes into play. It's a measure of your willingness to withstand changes in your investment's value. Some people might be willing to take on more risk for the chance of higher returns, while others might prefer to stick with safer investments. Now that you understand risk, let's explore how you can manage it. The first best practice for managing risk in investing is diversification. Now, what does diversification mean in the context of investing? Simply put, it's spreading your investments across various asset types to reduce risk. Imagine putting all your eggs in one basket. If that basket falls, you lose all your eggs. But if you put your eggs in different baskets and one falls, you still have eggs in the other baskets. That's diversification. You can diversify your portfolio by investing in different asset classes like stocks, bonds, real estate, and commodities. You can also diversify within an asset class. For instance, in the stock market, you can spread your investments across different sectors like technology, healthcare, or consumer goods. Diversification won't completely eliminate risk, but it can help to mitigate it. When one investment performs poorly, another might be doing well, balancing out the impact. Remember, diversification is your first line of defense against risk, but there's more to risk management. The second best practice is to regularly review your investment portfolio. This is akin to going to the doctor for a regular checkup. Just as you would assess your health and make necessary adjustments, a portfolio review allows you to evaluate your investments and make informed decisions. During these reviews, pay attention to how individual investments are performing, whether they're meeting your expectations, and if they're still aligned with your financial goals. The performance of your investments doesn't exist in a vacuum. It's influenced by a variety of factors, including market trends, global events, and changes in the economy. So why is this regular portfolio review crucial for risk management? It helps you keep tabs on volatility, identify potential issues before they escalate, and rebalance your portfolio as needed. It's about staying proactive, not reactive. Remember, the market can be as unpredictable as the weather, but with regular reviews, you're better equipped to navigate through the storm. Regular reviews keep you informed about your investments and their risks. The third best practice for risk management is understanding and keeping up with market trends. So, why is understanding market trends so crucial? Well, market trends can significantly affect the risk and return of your investments. By staying updated on these trends, you can make informed decisions and adjust your investment strategy accordingly. Now, let's delve into what market trends are. They essentially represent the general direction in which a market is moving. This could be upwards, known as a bull market, or downwards, referred to as a bear market. There are also sideways or horizontal trends, where the market isn't making significant moves in either direction. Understanding these trends is essential because they give us an insight into the market sentiment. For instance, in a bull market, investor confidence is high and prices are generally rising. Conversely, in a bear market, investor confidence may be low and prices might be falling. By identifying these trends, you can adjust your investment strategy to maximize returns and minimize risk. But how do you stay updated on market trends? There are several strategies you can employ. First, you can read financial news and reports regularly. This will provide you with information about the current state of the market and help you identify any emerging trends. Second, you can follow financial analysts and experts who share their opinions and predictions about the market. And third, you can use technical analysis, which involves studying historical market data to predict future trends. Remember, though, that trends can change rapidly due to various factors such as economic indicators or geopolitical events. Therefore, it's vital to not only understand the current trend, but also to anticipate potential shifts. This can help you to react swiftly and adjust your strategy when needed. Finally, it's important to note that understanding market trends should not be the sole basis of your investment decisions. It's just one of many factors to consider when managing risk in your investment portfolio. Staying updated on market trends can help you anticipate and manage risks before they impact your investments. The fourth best practice is seeking professional advice. Now, you might be wondering, why seek advice when I can do it myself? Well, there's a reason why financial advisors and investment professionals exist. They are trained to understand the complexities of the financial world and can help manage your investment risks effectively. Think of them as your personal financial coaches. They can guide you in making informed decisions, help you understand market trends, and even assist in diversifying your portfolio. They are equipped with knowledge and experience that can help you avoid common investment pitfalls. Moreover, they can provide you with personalized strategies based on your financial goals and risk tolerance. They can help you navigate through the financial maze and ensure that your investments are on the right track. Professional advice can provide you with insights and strategies that you may not have considered. So don't hesitate to seek professional advice when it comes to managing your investment risks. Managing risk in investing doesn't have to be daunting. And with that, it's time to wrap up our discussion on the best practices for managing risks in investing. We've explored the concept of risk, reminding ourselves that while investing inherently involves risk, it's not something to fear, but rather something to understand and manage. We've delved into the importance of diversification, highlighting the old adage, "Don't put all your eggs in one basket." By spreading out investments across a variety of assets, you can mitigate the impact of a single investment's poor performance on your overall portfolio. We've underscored the significance of regular portfolio reviews. Keeping a pulse on your investments and adjusting them as necessary is crucial. Markets change, and so do personal circumstances, and your portfolio should reflect these shifts. We've talked about the importance of understanding market trends. While it's impossible to predict the future, looking at historical trends and current market conditions can provide valuable insights. Remember, investing isn't a gamble, it's a strategic game. Lastly, we've emphasized the value of seeking professional advice. While it's possible to go it alone, having the guidance of a seasoned professional can provide a valuable perspective and help avoid costly mistakes. But remember, these best practices are not a guarantee of success. They are tools to help you navigate the unpredictable world of investing with greater confidence and control. The key is to stay informed, stay engaged, and stay committed to your investing journey. Investing can be complex, but it doesn't have to be intimidating. With the right strategies and a proactive approach to risk management, you can take charge of your investments and grow your wealth in a way that aligns with your financial goals and risk tolerance. Thank you for joining us at House Lux Estate. We're committed to providing you with the knowledge and tools you need to make informed investment decisions. Remember, managing risk is a key part of investing. Don't forget to subscribe for more insightful videos. Let's navigate this journey together.